Welcome to The Real Disruptors, presented by NAI, Latter Blum, making informed commercial real estate decisions in Louisiana's changing landscape. This podcast is hosted by FRANZ BORGHARDT and offers an outsider's perspective to real estate.
All right, welcome to episode 2 of The Real Disruptors. My name is FRANZ BORGHARDT. We've got a great panel lined up today, and we're talking about investment vehicles, how to make investments in commercial real estate. Now, to do this, we wanted someone that actually has real business savvy, real money, assets. So we thought, Matt Flynn. Matt is the CEO of My High, as well as you're involved in a celebrity golf tournament. You're the Matt Flynn golf tournament, right? Invitational golf tournament benefiting Heritage Ranch. Matt's going to be the person who's playing the part of investor today. And we've got a panel of commercial real estate oriented experts to give Matt advice on how to basically spend his money, his tons of money. It's all liquid gold, baby. It's all liquid gold. So our guest today is we have Ty. Ty, tell them a little bit about yourself.
I've been a local, lowly real estate broker at Latter Blum for 16 years.
All right, Trey.
I've been a broker at Latter Blum for a little bit less than that, but also started a private equity group called JRE Private Equity, and basically what we do is we put together commercial real estate investment vehicles. We go out and raise money hopefully from people like Matt, and we take that money, line up the debt, line up the management. We do everything from start to finish, and we give our passive investors a return on their investment.
And last but not least, Jpurgerson from Citizens Bank.
Yeah, I've been at Citizens for 21 years, started right after middle school. I've been in banking for 21 years.
Awesome.
Yeah.
And what do you do with Citizens?
I'm Chief Lending Officer, manage the loan portfolio, but I also hold my own portfolio of clients as well.
So I want you gentlemen to consider Matt your typical investor. Okay, he's an entrepreneur. He's involved in the community. He's doing quite well in business, and he's got some money he wants to put into a diversified, opportunity or opportunities, with the exception of like Bitcoin. You don't want to do Bitcoin. That's another conversation for another show. So we're going to start with Trey. Trey Williams, what is the number one most important thing that Matt should be aware of when approaching investing in this world?
Okay. Well, so I think really it's, rather than look at the most important thing, you got to kind of go back to the basics, and you got to understand like what you're looking for in commercial real estate, because you have money, you want to invest that money, and you want to get a return on that money. That's basic and elementary, you know that, but the amount of money that you get in return is dependent on how much risk that you're willing to take. And so when you look at an investment, when you look at your financial portfolio, you've got bonds and you've got equities. Well, the bonds are typically going to be lower risk, but they're also going to have a much lower return. Your equities in the stock market, that's where you're going to get your higher return because you're taking some risk. You might also lose it all, but with risk comes return. So when you look at commercial real estate, you got to understand that if I come to you and I say, Matt, I got an investment that's going to make you $100,000 a year, how much are you willing to pay for it? And you don't have to answer me, but let's just say I tell you it's $100,000 a year and it's leased to Chick-fil-A on College Drive. It probably pays a lot more than that. You say, okay, well, I'll pay X for that. Oh, what if I say, I'm going to give you $100,000 a year, but it's an office warehouse up on Choctaw, and it's leased to, Joe the Carpenter. Well, are you going to pay the same amount for that? Like, of course you're not, because you don't necessarily have a stable tenant, and you're not necessarily in the best area. So it's all about gauging risk and figuring out how much risk are you willing to take? So like for JRE, what we try to do is we try to stay on the lower end of the risk spectrum, but at the same time, we're not promising anybody 25 and 30% returns on their money every year.
What's a standard rate of return?
Well, so it depends on the properties that you're talking about. If you're looking for, I would say like bond equivalents, all right? So if you're looking for properties they're really going to give you a steady return, like a Walgreens or a Chick-fil-A or something like that, a Cane's. You can be looking at, anywhere from they're priced on cap rates, and a cap rate is basically a snapshot of what your return is next year. So you can expect anywhere from like a 5 to a 7, maybe a 7.5% return for those really good properties. Would you agree with that, Ty?
It's so wide. The spectrum is so wide. It just really depends on what you're looking for, as Trey's already mentioned. But yeah, no, I think on the total investment, 5 to 7% for things that are safe, and once you add some debt in there, the cash on cash returns can go up from there.
But see, the flip side of that is that look, if you want to really take some risk and you want to really make some money, well, I mean, then you've got, so those are what we would call core investments. That is a strong tenant, a good location, and a long-term lease. You don't have to do anything except collect a check. But when you go to what, on the risk spectrum, on the other end, you've got what they call opportunistic investments. And that's where you can make some real money in that, but you can also lose it real quick. And that would be like going and buying a piece of land, on Highway 30 and doing an industrial subdivision. And
Let me jump in here. So what is the difference? And again, I'm the outsider to this, and I'm a lowly criminal defense attorney. If you were to tell me you have a Ponzi scheme that's shaped like a pyramid, I would look at Matt and say, probably not a good idea, buddy. But you've touched on something I'm curious about. The difference between owning commercial real estate and leasing it out versus your model of a venture capital kind of private equity. What is the difference there in terms of investment?
as far as the investment itself goes, there's really no difference, except, so like for us and our investors, so our investors, if they put $100,000 into one of our investments, their exposure or their liability is only $100,000. Right. If they go out and buy a piece of property themselves, then first of all, it's going to be a much larger chunk than $100,000 right. to get a good investment. But they've got to go out and secure the financing. And right. if something goes upside down, they're on the hook for that financing, which Mr. Purgerson over here, I mean, that's what they do. I mean, they're a bank, they make the loans. And I mean, like, what are y'all looking for when you look at an investment? What makes you say this is a good one versus this is not a good one?
Well, before you go there, just to answer your question, Trey's sourcing the deals and managing it, the asset management. He's providing a service
right.
so that Matt can keep working all day,
right.
making his
Correct.
income.
Matt's not having to property manage. He's not
Correct.
having to do all those things.
Correct. What I do with most of my investors who, for the most part, are in commercial real estate day in, day out, we're going out and finding land, greenfield land, entitling it, working with the Corps to mitigate it, and then developing it. There's higher returns, but those are investors that's what they do all day.
Right.
And so that's a whole nother conversation if we want to get into that later.
Sure.
Thank you for the clarification, and that was a good clarification.
All right, so Jim, what are your thoughts on this?
Well, what I usually do, and I mean, I feel calls like this all the time from Ty and Trey and their clients. We really like to partner on the deal at the beginning, as if we are going to be the biggest investor, being the bank, right?
In the pocket, right?
And we're looking out for us and our shareholders, but we are also looking out for our potential clients. So a lot of times when I get a call, like Ty will call me and say, hey, I'm looking at this industrial park deal for one of my clients. Hey, can you shoot me the numbers? Usually the numbers are available just to anybody. There's not a lot of privacy when it's out on the market. What's the return and stuff? And then we size it up. We look at what else is going on in our portfolio. And but every deal is different,
right?
Like Ty said, and the higher yield ones carry a lot more risk. But if it's done right with the right partnerships, you're not going to win on every single one, but you stand to gain a higher return.
Yeah. So there's three forms of revenue or wealth from investing, and Baton Rouge lacks one of those. But there's the cash flows that you make after you pay the bank, and then there's the principal reduction. So in real estate is a really fascinating investment because it's one of the only that carries its own inventory, right? You buy something, someone else is carrying your inventory for you. The third one is appreciation. And Baton Rouge has a hard time with, especially on new construction, fancy construction, the more appealing stuff. It doesn't appreciate all that much that you're seeing in core markets like Houston, Dallas. So you kind of have to cater your investment program to the geography as well.
So I'm going to change gears a little bit, guys. If you're Matt Flynn and you're having the conversation with you guys and you were wondering what should Matt stay away from, what are the investment opportunities, and I use that with quotation, air quotes, what are the opportunities that he should stay away from?
Well, it's a different answer now than it was 6 months ago.
Well, that's part of the question, right?
You know, if you have a whole lot of office inventory, and again, it goes back to diversification, right? Which is great.
That's the
for,
key word right
you know, a company like TREY's, they're going to focus on spreading your investment out over several different asset types. But if you have a bunch of office right now, you're probably wondering what the future of office holds. If you have retail, you're probably trying to figure out which tenants you're going to have to backfill in the next 6 to 12 months. Multifamily and industrial guys are sleeping pretty well. Hotel, you're probably looking for capital for the next 6 to 12 months to make those lender payments. So it just depends, and a year from now may look totally different than in February or January when we had the highest jobs report of all time and all systems go in all real estate classes.
So am I hearing you, and I don't want to put words in your mouth, proceed with caution? Bide your time?
Absolutely. Just you don't want to go all in
Right
anything
now.
because there's bulletproof investment portfolios right now that are really, really rickety.
Yeah, I wanted to chime in on that. I think you have to be willing to adapt to change. I know a lot of y'all's clients have retail, for example, and if you're willing to reinvest in the property, keep it current, you may, for example, not have a bunch of inline goods sellers in your center anymore. You may have more fitness, more service now, or be willing to let medical come in your strip center. And I find the people that have had the best investments have been willing to listen to their broker, listen to the market. And a lot of times the market is, if you got a lot of vacancies, that's kind of telling you something if you have a good property,
Yeah.
So Trey, what do you think? What's to be avoided?
Well, I mean, I think one question that we ask for every property that we take a look at is, first thing we ask is, what if we lose the tenant? What do we do if we lose that tenant? And so are we in a good enough area where we think that we can backfill? But it's not just that. It's also, you got to look at the lease rate. So if you've got an office, say a garden office on Bluebonnet, just because there's a lot of them and it's kind of easy to get a market rate, so to speak. So you've got a garden office on Bluebonnet, and you've got a tenant in there paying $30 a foot. Okay, and you're about to buy this investment, got a tenant paying $30 a foot. That is exceptionally high for that corridor. So you would probably want to approach that with more caution than you would go in and find somebody paying, say, $15 a foot. So that comes into a lot of our decision making is, well, if we lose this tenant, it doesn't matter how strong they are. If we lose it, what is plan B? And can we backfill it? And if the answer is, I don't know what we're going to do, then we probably don't want to do the deal. If the answer is, we think that we can do that, well, then now we're thinking, well, then how much are we willing to pay? Back to that risk thing. How much are we willing to pay for that risk? So if we think maybe we can backfill it, well, we might say, instead of paying that 8% return, we need to see a 10% return on that. That's worth it at a 10% return.
Is there such a thing as something that is too good to be true? So in my industry, when I smell something, hear something that smells a little bit too good to be true, my spidey senses go off, and I'm like, In 2020, we're recording this in September. COVID-19, we're in phase 3, but it's a parish by parish thing. 2.1. Are there situations right now where things are too good to be true that Matt needs to be aware of?
Always. There's always someone selling something that the problems I see most of the time on the too good to be true deals are that the buyer didn't do the diligence up front. And you have environmental issues, you have title issues, you have boundary agreement issues, survey issues, elevation issues, wetland issues. I mean, there's a million ways to get in trouble on a property, not to mention the credit risk of the tenant if it is a cash flowing asset. There are deals out there. Whenever you have a COVID or an 08, 09, there's distressed deals out there. There's people that were over leveraged beforehand that the last 6 to 10 months have made it even harder to get out of a situation. But those are far and few between. And as real estate professionals, our job is to really educate the seller as to what the true value is. So a lot of stuff you see on the market, is priced accordingly.
So you're in, Matt, you are the CEO of a company named MyHigh. What does that company do?
So we focus on healthy hydration. So
Okay.
electrolyte drinks, beverages, really updating the science of what the average sports drink is. So when I started the company back in 2015, we entered into a couple of years of just really studies, hydration studies, sweat studies. Put a lot of people a lot smarter than me around me, and developed a really cool product. And so clientele is everything from youth sports to the safety world. Hard hat employees, people out there working in the heat, day to day, to college, professional, high school teams, and beyond. So it's just we're based here in Baton Rouge, and we have a place here we produce, and we have a office warehouse plant that we lease out and produce all of our products. So in the world of commercial real estate, I'm enjoying hearing what y'all are saying and getting kind of an education on it. I'm a novice certainly, but I've kind of dipped my toe in it as far as being a business owner and being a tenant. So
Jim, now that we have what Matt does for a living on the table, would that modify any of the advice you would give him, or would that shape it?
I mean, it may shape it. Like, number one, you may want to have a longer strategy to get out of your lease situation if you don't already. It may be the best. There may be a very good reason that you are leasing, but it could be a really good first investment to find another office warehouse. The other thing is it's going to be wise for you to dip your toes in the water in other product types. Of course, you want to listen to your realtor, look at the deals. But anyway, and I like my high too. If y'all haven't had it,
I hear good stuff about
That's
it.
what I'm talking about.
it's good on the
Great plug,
It's good
Jim.
on the boat.
Great
When
plug.
you're on the golf. We've been sweating.
All right.
That's exactly right.
So Trey, same question to you. Knowing what he's doing, or expanding on what he's doing, does that shape your advice?
I don't know if it so much shapes my advice. I mean, I would ask, you should probably take a good look at your opportunity costs with MiFi, and again, assess your risk, because again, it all goes back to assessing the risk and determining if the risk that you're taking is worth the return that you really think that you're going to get. So if you're in a, I don't want to discourage you from buying commercial real estate, but if you're in a situation where you feel very confidently that you could continue to invest in MiFi, and for each dollar that you invested, you could make 50 cents on that dollar.
Sure.
Then, invest in your company, but always keep in the back of your mind the word that Ty said was diversification. I mean, you do need to, in the same way that you want to diversify your stock portfolio and your bond portfolio, you really, if you're going to be in commercial real estate, you really want to diversify as well, not just amongst risk factors, but amongst property types. So we've talked a little bit about, there's multifamily, there's apartments, there's retail, and then within retail you've got single tenant, triple net retail, and then you've got like shopping centers. Then you've got office, and then even within office you've got garden office, you got big tall buildings. So there's a lot of different property types out there, and I would say if you do want to be in commercial real estate and invested, try to be diversified. Would you agree with that, Ty?
You want me to answer that question?
I would love for you to answer that question.
His
Ty.
question or your question?
Both.
Okay. All right.
And I can I'd like to shape the question a little bit.
Well, it is your money, so
from my seat here as a business owner and trying to grow it, and being that we are, we have a physical location. At what point do you guys work with clients in similar situations? As companies grow and expand, they need a bigger footprint, they need a bigger warehouse, office, whatever that may be. At what kind of point do you work with clients that say, at what point do I need bigger space, or is it more advantageous for me to build the suit from the ground up, or find space that's available and tailor it to what you need?
we're gonna give Ty first crack at this one.
Okay. There's software out there that you plug in all the questions,
There's an app?
and it's not quite an app. It takes a little bit of input, human input, but there's ways to go through and assess all of that based on your investment in the company and the returns that you're making. And so it's something, the CCIM class, that was one of the things we spent an inordinate amount of time on was, I think Starbucks was our example back when I went there decades ago.
New York, right?
Yeah, you just talk
Class
about
number 3, lease versus own.
So,
there's a process to
so
that.
let me put myself in your shoes for a second. From what I'm hearing, there's a software that will forecast what he should do as an answer to that question, right?
Right.
So the follow-up question becomes is what's the reliability of that forecasting for this app? Because if I'm you and I'm hearing, hey, wait, you're just going to put all this data in this app and it's going to spit out an answer, how do you, going back to risk assessment, how do you assess the forecast?
It's not hard and fast. What it's going to do is give you some barriers to stay with, some boundaries to stay within. And if you're off a couple percentage point on each side, you can still make an educated decision. All it's doing is really educating you on where your money's going right now and where it could go. What are the other places that you could stash it? To go back to the earlier question, though, a lot of times people in your situation, real estate is safe relative to starting up a business or cash flows that are coming in, through expansions and things of that nature. So a lot of times, brick and mortar is there, So if you buy it at the right price and your tenant leaves, it still has value, unlike an equity or something that can go to zero. So a lot of times, what we're doing is just taking excess funds that the business doesn't need and reinvesting them so that the client doesn't spend them on a boat or go get a camp or you know what I mean. It's harder to spend when it's in real estate and it's working for you. And if you build up $8, $9, $10 million of debt on a $15 million portfolio, you're paying off $300,000, $400,000, $500,000 of debt every year. And so the numbers just start to work for you. And over a 10, 20-year lifespan, it's pretty lucrative.
Jim, same question from Matt. How would you respond to that?
Yeah, I think, just like what Ty said, when you look at the numbers, that isn't everything. He had mentioned, environmental, all the other things. In a class that we took, it was one where we analyzed which corner should a Starbucks be on. I think that was the case you were talking about. And at the end of the class, the teacher said they ended up putting one on 3 of the 4 corners because where the subway stops were coming out. So, but anyway, taking excess cash and throwing it at the real estate, if it's the right investment, in 15 years, you're going to have a steady source of income if you're a buy and hold person. If you want to keep building and get a little more aggressive, you may sell and go on to another opportunity or another property type. You may buy apartments and decide, I don't have enough to have an economy of scale. I'm going to sell those and get into industrial. It's kind of boring, but I'm going to get a check every month, and I'm going to get to just grow my so.
Trey, I'll let you have the last word on this one.
I'll go in the opposite direction.
Trey.
Yeah, sorry. There's a thing called a sale leaseback, and so in this situation, I'm going to assume that you do own your building, and that well, doesn't necessarily depend on what your personal financial position is, I guess. But when you own your own building, if your business needs excess capital, like say there's a machine that you just really need to buy that you don't have enough money to buy. You can do what they call a sale leaseback. So you would come to a developer or investor or somebody, and you would say, okay, well, look, I'm going to sell you my property, so you get a huge influx of cash for selling the property, but then you sign a long-term lease with the investor. So maybe you know you're where you want to be. You don't want to go anywhere else. You want to stay there. Well, you sign a 10-year lease with 2 5-year extensions. You're there for 20 years if you want to be, but you need to buy that $500,000 piece of equipment because you can double your production, but for so you essentially your costs to continue your global cost to continue operating your business might stay the same, but you've got this new piece of equipment, and so you can double your production within the business. So a lot of these things matter, and a lot of these are very circumstantial. So not just with the property, but with your personal circumstances, and that's again goes back to what Ty was saying. A big part, if I remember correctly, a big part of that analysis was the opportunity costs of the business itself.
There's a significant amount of inputs that have to go into it. do that, you would just have to dig really deep into your processes.
So we've got about 3 minutes left, guys. I want to talk about the X factor that we haven't talked about yet. So Matt's very much concerned about personal health, right? Community footprinting. So if Matt cares about bettering the world, bettering Baton Rouge, bettering the community, I mean, you're a part of a golf tournament that's helping out. How do you incorporate that into the conversation? It's not all dollars and cents. Maybe it is all dollars and cents. How does that, in the remaining time, how does that get evaluated?
You got the right guy on the panel for that.
Just in terms of placing your business somewhere that helps the community and hiring there. Yeah, that's a great question. There's a few rabbit trails that we could go down. So that's something that, having a few minutes to kind of formulate my thoughts would probably answer a little better. But there's a bunch of ways to help your community. One is placement, going in areas that need some help in terms of redoing the real estate itself, or through the business itself, and hiring people that need that help, whether it's an apprentice program, work release, things of that nature. But again, that has everything to do with the heartbeat of the company and kind of what their mission is. And there can be some associated risks with going in areas that there's a long-term play in terms of bringing the area back. So that's all up to the operator and the company.
So if people want to connect with you, Ty, where would they go?
LatterandBloom.com.
All right. Jim?
citizensbankandtrust.com or Twitter or Instagram.
Trey?
Right, yeah. Go to GoJRE, G-O-J-R-E.
I was looking for a website. What's that website again?
Go, GOJRE.com
All right.
/PE, private equity. That is our website.
So speaking of bettering the community, before we leave, Matt, you are spearheading a golf tournament, correct? Tell us a little bit about this great tournament that's happening October 20th.
Yeah, it's an organization that's kind of near and dear to my heart. It's the Heritage Ranch Christian Children's Home. It's located in Zachary, but really it services the greater Baton Rouge area. It takes children that are in some sort of family crisis situation and rehabilitates them, works with their family, and it's just a really great organization here. And so I teamed up with them about 4 years ago and started the Matt Flynn Invitational, and all proceeds go to the Heritage Ranch. Trey, I think you're involved as well with the ranch, and it's just a great cause, and it's one of the I'm a golfer, and it's one of the best golf events that I've been around in the area, and they do a really good job of putting it on. But it's for an even better cause. So the tournament's October 20th. There's a noon shotgun start. You can go to hrbr.org for all the details, and we ask being a local organization, donate your time, donate your resources, whatever it is, but come out to the golf tournament, have a great time. I think this year they're doing a virtual gala this year. Of course, with COVID, you can't do a normal get-together like that. So, you can go to hrbr.org for all the information. Sign up for the golf tournament. I think we have a couple of spots left for the tournament.
I already got my team, so.
There you go.
I'm ready.
Perfect.
Well, Matt, thank you for playing the part of investor. It sounds to me that you probably got some good advice that you didn't have to pay for just now, which is great.
That's exactly right. I wish I brought my notepad with me.
That's all right. I'm sure you know how to find these guys. That's about it for this episode of The Real Disruptors. You've been listening to Franz BORGHARDT and a panel of experts. We'll put in the show notes how to get in touch with each of these brilliant guys, and I would encourage you strongly to check out the golf tournament. Again, thank you for watching, and we'll be here next time.
Thank you for joining The Real Disruptors, presented by NAI Latter Blum, Louisiana's leading commercial real estate advisory firm, offering expertise in virtually every property sector, including office, industrial, retail, multifamily, and hospitality. NAI Latter Blum has offices in New Orleans, Baton Rouge, Alexandria, Lafayette, and Lake Charles. For more information, visit latterblum.com. That's www.latterblum.com.